Throughout the past 5 years, CVS was trading at around $100 a share, but since then it plummeted by almost 50%, and over the past year the company is down by almost 20%. And so today we will figure out if CVS is currently trading undervalued near its 52-week low, and if buying it now will yield you great return in the near future. And to do this, as always, we will have a look at the fundamental 9-pillar analysis and calculate the intrinsic value of CVS using our 4 valuation models. Now, after plugging in CVS's ticker, we can see that they have a very juicy dividend yield of 4.62% and a dividend payout of $2.66. Now, one thing I love about the company is their low trailing free cash flow payout ratio of only 26.69%. which leaves them with a lot of their free cash flow left over to direct into innovation, buy back shares, increase their dividend, and pay off debt. Now, if we have a look at the company's market capitalization and at their enterprise value, we can see that there's quite a big difference, and the difference is the debt of the company. So that's the first thing I don't like about the company. Their debt is about the size of their market capitalization. But let's have a look at their 9 pillars, and we can see that the company gets a rating of 9 out of 9, which is a very clean rating. So first, let's have a look at the company's growth over the past 5 years. We can see that the revenue has been growing at a decent rate of 7.55% yearly. The free cash flow has been growing at a low rate of only 2.30% yearly, but the net income has been growing at about 16.77% yearly. Now, if we have a closer look at the free cash flow growth of the company, we can see that since 2019, they haven't increased their free cash flow at all, and year over year it has actually fallen by 83.77%, and that is also one of the main reasons why the company is falling in price. Now, their net income has been growing a little better, growing from 6.6 billion in 2019 to 8.3 billion in 2023, but year over year again a fall of 40%. So in 2024 we can say that CVS hasn't really done a good job. Now, one thing I do want to point out is if we have a look at the revenue that has grown from 255 billion in 2019 to 356 billion in 2023. That is a higher growth than the net income. And one of the reasons for that is if we have a look at the 5-year profit margin currently sitting at 16.91, if we have a look closer, we can see that that has actually been decreasing over the past 5 years at a rate of about 4.41%. And so even though the company's revenue is growing, their net income is growing at a lower rate. So the decreasing profit margin is another thing I don't really like about the company. Now, we also want to have a look at their long-term liabilities over the 5-year free cash flow negative dividends. And what this essentially tells us is that CVS generates enough free cash flow to cover all their long-term liabilities, so essentially debt, while paying out their current dividend. And we can see that CVS's ratio is sitting at 1.46, which is in the range we like to see, so they won't have any trouble with paying off their debt anytime soon. Though again, something I do want to point out, as we know, since about 2022, the company's free cash flow was falling, and we can see that since the same year, the company actually took on more long-term liabilities. And so if the free cash flow keeps decreasing, this ratio will get higher and the debt situation will get a little uncomfortable. And now let's finally have a look at something I love about the company, and that is their low 5-year PE ratio sitting at only 15.44, which means that investors are paying only $15.44 for every dollar of the company's earnings, which is less than what they are paying for every other average company. Now, we also want to have a look at the price to free cash flow over the past 5 years, which is essentially the same thing as the price to earnings, but we have a look at the free cash flow instead. And we can see that this is sitting at only 8.11, and you all know that I love when the price to free cash flow is even lower than the PE ratio, as the free cash flow of a company is essentially the thing that is used for everything, used for investing back into the business, paying off debt, buying back shares, and increasing the dividend, while the earnings, so the net income, is essentially just a measuring metric. So if we have a closer look at the price to free cash flow, we can see that currently it is sitting at only 7.03. So investors are paying only $7 for $1 of the company's free cash flow, which is 3 times less than what they would pay for the free cash flow of an average company. So even though CVS has decreasing free cash flow, they are currently trading very cheap compared to the free cash flow they currently generate. So all of a sudden, the fact they didn't increase the free cash flow over the past 5 years doesn't look that bad. Now the company also have decreasing shares outstanding at a rate of 0.53% yearly. Now if we have a closer look at this, we can see that in the years when they were trading expensive, they were actually selling out shares, which I really like. And then when they started trading cheaply, they started buying back the shares. Now I also want to have a look at the consecutive dividend growth of the company, which is sitting at 5.49% yearly over the past 5 years. But if we have a closer look, we can see that they didn't increase their dividends at all in 20 and 21 and increased them by 10% in 22 and 23. And over the past 12 trailing months, increased them by 7.44%. So we can see they don't have such a good consecutive dividend growth. But now let's calculate the company's intrinsic value, first using the Grams formula revised. Now I plugged in a 5-year earnings growth estimate at 10.68%. And the way I calculate this is I take the high earnings per share growth estimate at 7%, medium at 6%, and low at 4%, and then average it out with the analyst projections. Now to get the intrinsic value of the company, we take the 6 values and get an intrinsic value of $115.47, which is 51% higher than the current trading price of the company. Now for the second valuation model, we want to have a look at the free cash flow of the company. So we take the free cash flow of the past 5 years, as we know it hasn't been growing at all, and we calculate the growth rate. So I predict a high growth of 7%, medium growth of 5%, and low growth of 4%, and get a future growth rate of 5.3%. Now with an initial growth number of 7 billion, we calculate the future free cash flow. Now plugging in the discount rate at 6.9%, we calculate the present value of that future free cash flow, summing all of that up, adding cash and cash equivalents, and subtracting the high total debt, we get an equity value, which we divide by the shares outstanding and get an intrinsic value of $105.45, which is again close to 100% higher than the current trading price. Now for the third valuation model, we will compare CVS to 4 of its competitors. We will take these companies' current stock prices and divide by their earnings per share to get their PE ratios. Now we can already see that CVS's PE ratios is lower than the average price to earnings of these 4 companies. So when we multiply it by the earnings per share of CVS, we get an intrinsic value of $116.30. Now moving to the final valuation model, the dividend discount model, we take the growth rate of the dividends over the past 5 years and calculate an average growth rate of 5%. Now as we know, CVS's dividend growth isn't as consecutive, so I project the growth rate of 3.67% into the future and get an intrinsic value of $76.61. And finally, when we average out these 4 valuations, we get an intrinsic value of $103.46, which is 81.82% higher than the current trading price of the company. And so if we plug in a margin of safety of 40%, we still get an acceptable buy price at $62.07. Now, as we saw, CVS isn't 100% perfect. They have decreasing profit margin and they haven't increased their free cash flow over the past 5 years at all. But from our analysis, we could see that with the free cash flow they currently generate, they are still undervalued compared to that free cash flow. Now I don't believe that CVS's price will shoot up, but I do believe that they will have steady above average growth over the next few years, as we see they are currently trading extremely undervalued compared to their earnings, compared to their peers, compared to their free cash flow, and compared to their dividends. And with that, I hope that you enjoyed the video. Make sure to leave a like and subscribe as it really helps me out.